Hi, today we're going to talk about some basic but important real estate terms. They're here up on the board. One is NOI, net operating income. Second is cap rate. Third is debt service coverage. And fourth is cash on cash. And so let's start first with net operating income. Net operating income is the income from operations. Basically, it's taking all the revenues of your shopping center or your other piece of real estate. So it's NOI, net operating income, equals revenue minus expenses. And so the revenue for a shopping center includes rent and all the reimbursements, base rent, and all the reimbursements that a shopping center owner receives for taxes, property taxes, insurance, and common area maintenance. So that's the revenue side. The expenses are all of the expenses, not including debt service, all the expenses associated with operating a shopping center. Parking lot maintenance, security, utilities, landscaping, any on-site administrative and personnel costs. Those are all part of the expenses. So net operating income is revenue minus expense. So let's use an example. Let's say that the revenues for a shopping center are $1 million, and that all of the expenses in a shopping center add up to $700,000. That means that your NOI is $300,000. That is the revenues that flow off of the property after expenses. Okay? That's cash flow, net operating income. Cap rate is net operating income divided by purchase price. NOI divided by purchase price. Okay? Purchase price. So let's say that this shopping center that produces $300,000 of net operating income cost $3 million to buy. Net operating income is $300,000. $3 million is the purchase price. That is a 10% cap rate. Or another term that's sometimes used is yield. Okay? So this buyer is going to get $300,000 for an investment of $3 million, a 10% cap rate. What happens if he needs to pay $300,000 for a Chick-fil-A ground lease, which is extremely good security? Chick-fil-A pays $300,000. He might have to pay $6 million to buy a Chick-fil-A ground lease of $300,000. That is a 5 cap or a 5% yield. So the value of that Chick-fil-A cash flow in this scenario at a 5 cap is worth more than the value of $300,000 for a $3 million investment. As cap rates go down, price goes up. As cap rates go up, price goes down. So one of the things about the shopping center sector is that in general, most shopping centers in today's world have positive leverage, which means that the cap rate is higher than the interest rate on the debt on the property. So if you're buying a shopping center at 10% cap rate and you're borrowing half of this at $3 million at 7%, that is positive leverage. That means by adding leverage to the property, you're increasing your cash returns to your investment. Let's go to the next issue. So let's take a look at debt service coverage. Debt service coverage is net operating income divided by debt service, okay? And debt service is your loan amount taking all 12 interest and principal payments you have over the year. That added up is your debt service. So let's say for this $3 million acquisition, if we're borrowing $1.5 million loan on a 7% interest rate on a, let's call it a 25-year amortization, then that number, 9 times, is about $135,000. This is just a guess on my part, but I use a rule of thumb that says the constant, the debt constant, which is loan amount times debt service. Debt constant is your debt service divided by your loan amount. I kind of know, I've done it so much that I know it's about 9%. So $1.5 million times 9%, that's your debt service. And then if that's your debt service, NOI at $300,000 divided by your debt service is about 2.2 times debt service coverage. So this is your debt service coverage, that you've got net operating income that's more than twice your debt service. Lenders like that. Typically, in a loan agreement, lenders require a minimum debt service coverage of 1.25 times to 1.35 times. And as you go higher, here it's above 2 times. That means that there's a lot of net operating income to cover the obligations of the bank. Lenders like that. Oftentimes, if you're below the minimum threshold, that is a default on the loan. Not a good thing. Now, what is cash on cash? So that is net operating income. Let's see if we have room over here. Net operating income minus debt service. Okay, so in this situation, it's 300,000 minus 135,000. This number of 165,000 is your cash flow after debt service, and then you take that number, so it's cash flow after debt service, after debt, divided by your equity investment. And under this scenario, it is $165,000 divided by 1.5 million, and that is an 11% cash on cash return. So let's summarize. You've got net operating income, cap rate, debt service coverage, and cash on cash. Net operating income, revenues minus expenses. In this situation, $1 million of revenues minus $700,000, that gives you $300,000 of cash flow or net operating income. You use net operating income as the numerator for determining cap rate. The denominator is the purchase price of the asset. Net operating income divided by purchase price is equal to cap rate. And the cap rate is a way to describe how much you're willing to pay for a certain amount and quality of cash flow. Debt service coverage is net operating income divided by debt service. This is the ratio that helps everyone, your lender, your sponsor, your investor, determine how safe or how risky the property, the investment is, in terms of will it meet the minimum debt service requirements and avoid any kind of default with your lender. The worst case of default is foreclosure, when the lender takes over the property and wipes out all the equity. Finally, cash on cash return is cash flow after debt service. So in this situation, $300,000 cash flow, or NOI after debt service, divided by the original equity investment. This says, from a pro forma perspective, that if I'm going to invest $1.5 million after debt service, I will the property will produce approximately $165,000. Now, what's good to know for an investor is that if this investment is paying an 8% preferred return, 8% of $1.5 million is $120,000, and the property is throwing off $165,000, then that investor knows that this property has a very good probability of being able to pay the preferred return, because the cash on cash return is greater than the preferred return.